Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thank you for joining us for our Tuesday, March 28th edition of Market Insights and Observations. We're going to talk about three topics today. As you know the deal already. Basically, it's what the markets are paying attention to, so we are too, and what we're expecting in the weeks and months ahead. We're going to discuss that. Another topic we're going to talk about is inflation falling, question mark. I don't know about your kitchen table, but mine, we still see high prices there. We'll talk about ultimately what's happening in the economy, and is there an inflection point as it relates to all this inflation data? Well, right now, this is what the Federal Reserve looks at. The Fed funds rate, as we're clearly at basically the 5% mark, the futures are pricing in staying at 5%. Let me get a different color here. Staying at 5%. Obviously, April, we don't have a Fed meeting. May, we do. The question mark is the Federal Reserve pause at that point? I think they've done enough damage. There's lagging effects of interest rates right now. There are cumulative effects that are actually now weighing on all parts of the economy. We just saw this last quarter, obviously, the stress in the small and the regional banks and the spillover effects as it relates to that. And ultimately, this is actually showing that as long as the Fed funds rate stays where it is, it's going to have basically a negative effect as if they're continuing to raise interest rates. That's the take-home point of this. So that means that even though the Federal Reserve might be on pause in May, meaning not raising rates anymore for the rest of this year, if they maintain, the longer they stay and the higher they stay where they are with the Fed funds rate at 5%, it's still going to have a tightening effect or a slowing effect of the economy. That's going to work to their advantage so that Fed can basically be in the driver's seat just in case inflation has sort of a double take, if you will, and slows down, but then picks back up. Potentially, we've seen that, again, late 70s, early 80s, and that was the biggest challenge there for the Federal Reserve back then. But as of right now, we believe the Fed will maintain where they are, and even in the back half of this year, we could see rate cuts actually playing out. Inflation expectations, this chart is talking about the good news, the 3-year and the year-over-year, the 3-month right now, if you look at it right here, inflation expectations and everything's moving in the right direction. For the Federal Reserve, that's important, imperative, and this is what the Fed needs. The only thing outstanding is the tight labor market. But we're still watching real rates closely, but it can be hit with a notable lag. Ultimately, the red dotted line here, up and down, here, obviously this is interest rates, the Fed funds. This is actual Fed funds rate. And now this is where they are relative to where the 10-year. And the 10-year, once it goes below, as it has in the past, then you get right here, recession. Is it recessionary right now? We don't know. But ultimately, I think if history has shown us everything, it doesn't match exactly, but it rhymes most of the time. So that's why a lot of the economists and a lot of sort of positioning is for a recession ahead. Now, why would that be? Several factors. But before we get to that, let's talk about the supply chains. Supply chains have healed, and that's good right now. But the labor market, again, is the tight last leg to drop, if you will, for the Federal Reserve. This is the supply chain pressure going down, which means it's moving in the right direction. That means there's not inventory buildup or delays. Delivery times are going down. Again, that's also from a manufacturing standpoint, keeping the economy running smoothly. That's deflationary, so there's not this supply and demand issue there. Freight prices are moving down. Those are all great indications that the policies and the Federal Reserve and inflation are all sort of on the same page. Now, the wage inflation price spiral still needs to be watched. Easy for me to say. And there's sort of an anchoring in. This is inflation right here, the CPI. Okay, it's gone up, and it's well over the 6%. The next read is April 12th. It's at 6%. We want that. Anything below a 6 handle on that, we believe that markets will rally. But if you keep in mind the most recent 6% rally or inflation read in February was energy, was food, was car prices, used car prices specifically. Those were still high. They've the trend has now rolled over a little bit, but still high nevertheless. But as we're seeing the trends and sort of wage tracker, this is a good one right here. This is the one that we want to pay attention to. Wages are coming down. A lot of corporations are now laying off. It's adding more people to the labor market. and that's getting rid of the tension that we're seeing. So right now, labor statistics, these are all the keys that we're keeping an eye on, but some of the inflationary pressures are moving in the right direction long term. Now, U.S. job reports have been solid as recently as the Fed Senior Loan Officer Survey indicated that the risks are still going forward. Banks tightening lending has also increasing the knock-on effects of basically, layoffs. And what happened in the banking sector and the small regional banks has a knock-on effect or a spillover effect within the U.S. economy, specifically in your little community. If the local bank is not going to be as lending, or they're going to be regulated. Let's call it regulators. They're in front of Congress right now, and Congress is going to come down hard and say, hey, listen, it's a regulation issue. It's not an oversight issue in terms of lack of management. Either which way, the net effect is going to be more attention and scrutiny, less risk aspect or risk in the portfolio for these small and regional banks. What does that mean? When you go right across the street here and you talk to your banker and you say, hey, listen, I'd like for small business, or I'd like it for my home, or whatever, I need a lending, corporate real estate. If the lender is constricted or restricted, they have less to give out, or they're going to be more conservative, or they're going to be slower to move that loan through. That is basically oxygen to the U.S. economy. That's the capital, or the velocity of money. There's less of it to go around. So by what just happened this last quarter, and one of the reasons why markets are kind of up, believe it or not. I mean, we just had a banking crisis, but we're going to end the quarter with basically the Dow, and the Dow is going to be down for the quarter, but the NASDAQ and the S&P by the end of this week could end up positively. We'll wait and see. But as of right now, they're up. Now, how could that be? How could the quarters be up, and yet we've had a banking crisis? Simply because the market looks through in its forward pricing mechanism, and it's seeing the knock-on effects of tightening lending standards, less money in the economy, less money, less costs of those dollars chasing, creating inflationary pressures. Or if you're a small business owner, you can't get the money or the capital to either reinvest or even hire people. That being said, that's what's to come, and history has repeated itself. If you look at all the gray bars, those are all the recessions. And ultimately, we have that when the red line goes above the blue line, and that's where we are right here. So is a recession ahead? Again, history could be the key there, and we'll see. Again, the consumer price index, ultimately, I'm not going to belabor the point, but prices are coming down, not across the board, but it's also helping. So what's next? Ultimately, we want to finish the quarter. We're doing a lot of rebalancing for our clients. We're, again, hanging out in short-term treasuries. We're seeing a lot of bank cash. We saw millions and millions of dollars rush into Blanke, Schein Wealth Management from the local regional banks, and we're putting that to work in treasuries. We're getting 4% in the short term, and that's we wait out, we hang out and see what's to happen. But we're also rebalancing, cleaning portfolios up, and being ready for the next quarter ahead. At least that's what we're doing for our clients here. If you have any questions or want to review or talk about or introduce us to somebody, we've been doing a lot of that lately. We've been a lot of and we're grateful for the introductions. So we're happy to talk about friends or family or anybody who wants a complimentary consultation with us. So that's our update for today. Thanks for watching, and we'll see you again next time.